Why does Bitcoin go up? Is it just magic internet money? Or is there a hard, unshakable economic engine running quietly in the background? To understand Bitcoin and why its value continues to rise over time, we first have to talk about something you are already very familiar with: gold. For thousands of years, humanity has collectively agreed that gold is valuable. But why? Is it just because it looks shiny and beautiful? Sure, that plays a small part. But the main reason gold holds immense value is because it is absolutely rare. Gold is a highly limited physical resource on planet Earth. We cannot simply snap our fingers, turn on a printing press, and create more of it out of thin air, like governments do with regular paper money. If we want to add more gold to the circulating supply, we have to physically mine it. Mining physical gold is a brutal, dangerous, and exhausting process. It requires massive, heavy machinery, intense manual labor, endless hours of digging, and millions upon millions of dollars in upfront investment. And here is the fundamental catch that drives the price. The more gold we successfully pull out of the ground, the less of it remains hidden within the earth. Because the remaining unmined supply is constantly shrinking, finding new gold deposits becomes progressively harder. It becomes much more expensive and requires drastically more energy and time. When the cost, the time, and the extreme difficulty of finding a raw resource go up, what naturally happens to the market price of that resource? It goes up too. The increasing rarity of gold and the massive, undeniable physical effort required to extract it from the dirt are the exact economic reasons why it has held its purchasing power across human history. Bitcoin takes this ancient, mathematically perfect concept of scarcity and digitizes it for the modern world. Bitcoin is quite literally digital gold. So how exactly do we mine digital gold if we cannot physically dig it out of the ground? We use computers. Mining mechanisms in the crypto world are essentially the complex methods used to verify and authenticate transactions across a massive decentralized network. This brilliant system allows the network to secure its own information perfectly, permanently, and transparently, without ever needing a central authority, a CEO, a government, or a bank to oversee it. The specific network we are talking about here is the Bitcoin blockchain, the indestructible public ledger where every single Bitcoin transaction is recorded forever. To protect this ledger and ensure nobody can cheat the system, Bitcoin uses the most battle-tested, common, and secure consensus mechanism in the entire world, known as proof of work, or POW for short. In this system, thousands of incredibly powerful, highly specialized computers actively compete against each other to solve mind-bending mathematical puzzles. The very first computer that successfully guesses the correct answer to the puzzle wins the right to create a brand new block of transactions on the blockchain. But these computers do not just run easily in the background of someone's laptop. Proof of work requires immense, unbelievable amounts of computing power and incredibly high electricity consumption. The computers are running trillions of calculations every single second. This makes the physical act of mining extremely expensive and highly restrictive. But that intense cost is exactly what makes the network so unbelievably secure. You literally cannot hack the Bitcoin network without spending billions of dollars in physical electricity and hardware, which makes cheating mathematically impossible. This heavy mechanism is what powers Bitcoin, intentionally and perfectly mimicking the heavy effort, the sweat, and the energy required to mine physical gold. The people, groups, and large-scale companies operating these massive computer networks are called the miners. But you have to ask yourself, why do they do it? Why would anyone spend millions of dollars on electricity bills and highly specialized hardware? There are three main reasons driving this global industry. First, purely for financial profit. As a reward for securing the network, burning all that electricity, and solving the mathematical puzzle, the winning miner is paid a specific amount of brand new, freshly created Bitcoin. Second, it is a massive, highly professional global business. Huge publicly traded companies exist on the stock market today whose sole purpose is to build massive warehouses filled with computers just to mine Bitcoin. It is an industry worth billions. And third, pure ideology. Many miners fundamentally believe in the core philosophy of a decentralized financial system. They want to support a network that solves the problems of modern banking. While you can technically still run a small mining machine from your house, the modern network is largely secured by massive, industrial-scale mining farms. And here is where the absolute genius of Bitcoin truly shines. Just like physical gold buried in the ground, Bitcoin has a hard, unbreakable, mathematically programmed limit. There will only ever be exactly 21 million Bitcoins. Period. Not a single fraction of a coin more can ever exist in the universe. Right now, as of the recording of this video, about 20.05 million Bitcoins have already been completely mined and released into the world. That means there is less than 1 million Bitcoin left to ever be discovered by the global network of miners. Now, if you are paying attention, you might be thinking to yourself, wait a second, if there are only a few 100,000 coins left in existence, won't the massive mining companies just run their machines at full speed, print all the remaining coins tomorrow, and crash the entire market by flooding it with supply? No. They cannot do that. And the reason they cannot do that is because of a brilliant, unchangeable piece of core programming called the halving. The halving is a built-in, automated event hard-coded directly into the Bitcoin blockchain, exactly every 210,000 blocks, which takes the network roughly 4 years to process. The exact reward that the miners receive for their hard work is violently chopped in half. Let me give you a very simple real-world analogy to make this mechanism crystal clear. Imagine there is a massive real estate developer in your country. The developer officially announces that in the year 2027, they are going to build exactly 100,000 brand new luxury apartments, but there is a strict, unbreakable catch in their contract. The following year, they are only allowed to build 50,000 apartments. The year after that, they are restricted to building only 25,000. They are legally forced to keep cutting their total production in half every single year until they build their very last apartment. What do you think is naturally going to happen to the market price of those specific apartments over time? If the demand from regular buyers stays exactly the same, or if that demand actually grows as the population increases, but the supply of new apartments entering the market is constantly and aggressively dropping, the price absolutely skyrockets. It is the most basic, undeniable law of human economics, supply and demand. As long as people want the asset and the supply goes down, the value goes up. This is exactly what the halving does to Bitcoin. It mathematically ensures that this digital gold becomes harder, slower, and exponentially more difficult to acquire as time goes on. In fact, because the mining reward keeps getting chopped in half every 4 years, the very last fraction of a single Bitcoin isn't projected to be mined until the year 2014. Think about the gravity of that statement. The crypto market has been around for about 17 years, and we have already aggressively mined over 20 million coins. But it will take more than 100 years of global computing power to mine the final fraction of a million. That is the definition of ultimate scarcity. This brings us to the final, and perhaps the most crucial piece of evidence. This is the direct relationship between the physical cost to mine a Bitcoin and the actual market price of a Bitcoin. Let's go back to our real estate developer example. Imagine it costs a contractor exactly $1 million in raw materials, manual labor, electricity, and city permits to build a luxury apartment. Do you honestly think that contractor is going to turn around and sell that finished apartment to you for $800,000? Of course not. That would be complete financial suicide. To run a functioning, living business, the contractor must sell the apartment for a price that is significantly higher than the cost of production, let's say $2 million. The global Bitcoin network operates on this exact same economic logic. The miners are the massive contractors. They have enormous electricity bills, hardware replacement costs, and facility rents to pay every single month. It is completely illogical and unsustainable for the cost to mine a Bitcoin to remain permanently higher than the market price of a Bitcoin. If miners are suddenly not making a profit, they are forced to turn off their machines. If they turn off their machines, less Bitcoin is mined daily. The available supply on the market tightens even further, and the price naturally corrects itself upward. The entire market must inevitably balance in favor of the miners to keep the network alive and secure. Look closely at this specific chart on the screen. It tracks two critical metrics over a long-term time frame, representing dollar values scaling up over the years. The blue line represents the absolute average cost for a miner to produce one single Bitcoin. Notice how this blue line generally keeps going up and up over the years. Why? Because of the halving. Every 4 years, these miners are forced to do the exact same amount of intense computational work, burning the exact same amount of electricity, but they get exactly half the reward. Therefore, their mathematical cost to produce a single coin effectively doubles every cycle. Now, look at the orange line. This is the actual, real-world market price of Bitcoin. Do you see the undeniable relationship between the two? The two lines are deeply and permanently connected. The market price, the orange line, spends the vast majority of its entire history floating comfortably above the cost of production, the blue line. During massive market bull runs and historical all-time highs, the Bitcoin price can violently spike to 2, 3, or even more times higher than the actual cost it takes to mine it. But what happens in the rare moments when the orange line temporarily dips below the blue line? What happens when Bitcoin becomes cheaper to buy on the open market than it is to physically produce? Historically, it never lasts. The economic gravity of the network pulls the price right back up. Right now, as of filming this very video, the market price of Bitcoin is hovering around $60,000, but the average global cost to mine a single Bitcoin has aggressively pushed up to around $73,000. Think deeply about what this data is showing you. The global contractors are currently building the apartments for $73,000, but the current market is pricing them at only $60,000. Based on everything we just looked at in the history of this exact chart, what does that tell you? It is a massive, flashing indicator. It suggests that according to historical data, a price correction upwards is not just a random possibility, it is an absolute economic necessity. When you combine all of these elements, the absolute scarcity of 21 million coins, the massive energy and unhackable security of proof of work, the halving cutting the supply every 4 years, and a climbing production cost that forces the baseline price higher and higher, you don't just have a random internet token. You have a mathematically perfect economic engine designed to appreciate in value